Institutional investors. These are the type of people who chase alpha harder than Wall Street interns chase validation from their managing director, who doesn't even happen to know their name. And in recent years, these interns and the trillion-dollar funds they serve have all been obsessing over one asset class. Not stocks, not crypto, not real estate, and not even artificial intelligence. And if you think you're the genius who can choose the next crypto coin winner, congratulations!
Has quietly cranked out a new wave of billionaires and is so dull-sounding it makes municipal bonds look sexy.
It's private credit. That's right. The most boring-sounding corner of finance has quietly ballooned into a more than $2.5 trillion juggernaut.
For context, that makes the global private credit market bigger than Canada's GDP. But let's be honest, that doesn't really count for too much anyway.
And here's the kicker. Private credit has delivered nearly identical returns to the stock market over the last 20 years. But with far less volatility. It's stock-like gains without the constant stock-like mood swings. So if private credit is so great, why does nobody outside Wall Street seem to know about it? Chapter 1. Private Credit, Wall Street's favorite secret. You've probably heard about private credit from some ZYN-slinging finance bro. You know the type. Patagonia vest, Red Bull in hand, and a nicotine pouch lodged so deep it's basically part of his personality. Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank, dap up some banker named Tucker, and boom, you had a loan. No questions, no stress. Tucker didn't care about your credit score, verifying your income, or the fact that your last company was literally a failed vape shop. Back then, loans were handed out faster than rashes on spring break. And surprise, surprise, that's how the financial system ended up with a hangover so bad it nearly killed the global economy. And as a result, after the 2008 financial crisis, everything changed. Banks turned into strict parents. Nowadays, when you walk into a bank, you beg for a loan, fill out 50 forms, offer your firstborn as collateral.
And maybe, just maybe, they'll give you money. And that's where private credit steps in.
Private credit is like the sketchy uncle who says, "Don't worry about that report card. I'll give you cash right now, but you might not like the interest rate." Instead of going to a bank, companies borrow from non-bank lenders like Blackstone, Apollo, or Eris. These firms cut direct loans, charge higher rates, and make strong returns. It's kind of like Venmo, except your buddy isn't sending you 20 bucks for pizza. He's wiring $200 million to a mid-market oil refinery so it doesn't go bankrupt. Chapter 2. The Rise of Wall Street's Secret Cash Cow. So why is private credit working so well? But before I jump into how private credit plugs a hole in the market, let's back up for a second. Back in the early 2000s, the private credit market was small, about $140 billion globally. It was the weird sibling of private equity, still niche, and still ignored. Then came 2008. Over the years, banks had been handing out loans like candy on Halloween. Started with the infamous ninja loans, which were loans to people with no income, no job, and no assets. Then banks started bundling these steaming piles of debt into collateralized debt obligations, or CDOs. The banks had blown up the economy by handing out loans to anyone with a pulse. So following the financial crisis, regulators stepped in and said, "It's time we start acting like responsible adults." These regulators rolled out a whole new rulebook that forced banks to increase capital reserves, cut leverage, and tighten lending standards. This meant that lending to small and medium-sized companies, which were the companies with higher risk profiles, suddenly wasn't worth the head. And so by 2010, traditional bank lending to these middle-market companies had plummeted. But here's the problem. These middle-market companies still need money. And now they were in an awkward spot. These middle-market companies were too big for your local community banks and too small to issue bonds on Wall Street. And that's where private credit steps in. Private credit funds stepped in and said, "Don't you worry. The banks may have ghosted you, but we've got you. Forget the collateral. Just sign here, pay 10% interest, and we'll tack on a few fees." And we'll do.
And companies lined up faster than white girls at a Lululemon sale.
In 2010, private credit assets under management sat around $300 billion. And by 2020,
And after several years of outsized returns, history tends to tell us we need to pump the brakes. Because corrections aren't anomalies, they're actually normal and healthy. However, as one famous market commentator showed recently, going short the market because of a gut feeling is probably not the best strategy.
As a famous economist once said, markets can remain irrational longer than you can remain solvent.
And that's the uncomfortable truth about the bear case. You can be right on valuations, right on healthy concentration, and right on overextended rallies, but still be wrong. Because being right too early is indistinguishable from being wrong. Which brings us to our bull case. Because what if markets continue to rip? What if they don't care about historical averages? And what if markets continue to remain irrational? So let's start with the fundamental tailwind that bulls are clinging to. 1. Interest rate cuts. Because whether you trust the central bank or you think policy decisions are made with a magic 8-ball, one thing is clear. Interest rates are coming down. And lower rates mean cheaper capital. Cheaper capital means higher valuations. And higher valuations mean investors are more comfortable paying premiums for future earnings. And that's why rate cuts don't just matter to borrowers, but also to valuations and trading multiples.
Because liquidity loosens, financial conditions ease, and risk-on assets come alive.
And that's how you can see markets grind higher, even when underlying economic data may feel mixed, confusing, or slightly uncomfortable. But just because the broader macro picture may feel uncomfortable, it doesn't mean that you also have to be. Which brings us to the sponsor of today's video, Notion.
Because normally when I'm doing research for my videos, I have macro reports, spreadsheets, and enough tabs open to make my laptop sound like it's preparing for liftoff.
But that's where Notion Agent comes in. You assign the tasks, and your agents do the work. Because now, instead of doing all the heavy lifting myself, I have the Notion Agent to help me.
Here you can see I've asked the Notion agent to provide a 2026 outlook on the gold industry and a table showing the total gold held by various central banks.
And with one click, the Notion Agent gets to work and handles everything for you. And the best part? If I want to add more data, the Notion Agent allows you to dynamically update as you go. So instead of juggling research from 5 different places, I'll leave a link below if you want to check it out. And now back to the shiny rock that's making everyone uncomfortable. Subscribe for more casual finance.